All right, so I received this letter from a financial advisory company, a trading advisory company. It's just promoting their retirement portfolio management, bullcrap services. And it got me thinking broadly about the financial markets. As many of you know, I've had a pretty bearish overall look into the markets. There's some stocks, specific names that I am bullish on, but overall, I have a lot of anxieties towards the underlying financial indices. And of course, we can go into the usual topics of questionable labor market statistics, some of the geopolitical tensions, international market weaknesses. Yes, those are all very valid points. But I think there's more of a fundamental and elemental reason why the markets are so prone to failure, especially at this juncture. And the reason has to do with your 401k plan or your 401b or whatever other retirement savings plan that you may have. Virtually all of them, I think all of them, are basically long side investments. Long side meaning that you buy a basket of stocks and bonds and assets, and you hope that they go up in valuation over the years. So it's a one-sided trade. It's a buyer's market, literally. And I noticed that none of these retirement funds, you can't short them. You don't have an option of having a basket of assets upon which you can initiate a short position and be bearish on them and then profit from their downfall. People think that the short traders, the bearish traders are morally dysfunctional people, that they take pleasure in other people's pain. That's so far from the truth that it's not even worth hashing over. In order to have a viable market, you have to have a market of buyers and sellers. You can't just have a market of buyers. But that's what the United States has basically engineered. The Wall Street aristocracy has engineered literally a buyers only market. The biggest volume comes from the retail sector. We have trillions and trillions of dollars amongst us Americans individually contributing to our retirement plans. And that aggregate total can only be used on the buy side. It can't be used on the sell side. That is the reason why you see a lot of so-called stability in the American markets, because I believe that other international markets, they let you have a mixture of buy-side and sell-side transactions. Not so in the good old United States of America, the land of freedom. You have a lot of freedom in terms of civil liberties, but when it comes to financial liberties, you have almost no freedom. This is like the financial equivalent of North Korea. You must buy because these are the glorious markets and you must buy and buy and buy. That's it. The only thing that you can do is to get out of a position. That is not the same as a short side, a short trade, because on a short trade, you actually profit when the markets collapse. Not so in the US. Because the retail segment of the markets are so heavily levered to the buy side only, that makes the markets, the US markets, appear as if they are stable and appear as if they are rising and rising and rising. But the problem with artificially buoying the major financial indices, the blue chip indices, is that you cannot cheat the market physics. At some point, there is going to be a correction back to the equilibrium. And by artificially propping up the markets, by forcing the retail aggregate to only buy stocks, that creates a massive amount of pressure. And as soon as there is enough force from panic, whoosh, we have these uncontrollable, unmanageable collapses that literally rock not only the US markets, but all the markets in the world. Because everybody's like, whoa, look at the stable US, and then whoa, it just collapsed. That's the risk.